Got a great email from somebody on the YouTube channel, and I'm going to read it to you. It's from Sandra Mistis, I think. I don't know if it's one name or that's a nickname. It's hard to tell because YouTube smashes it all together. But beginning is difficult. It's for the video how pro traders put their emotional house in order. Um, I've stopped overtrading and feeling any hesitation when it comes to action, but I still feel happiness when a trade goes as I planned. I guess that needs to be eliminated too, right? And the answer is no. I feel good when I make money on a trade. It's just that when I lose money, I don't fall to pieces because I kind of feel good too. Why? Well, because I followed my loss limiting methodology. So I take solace in my discipline and what I'm doing day after day after day. When I was starting out, this might help for you. It sounds like a bumper sticker kind of slogan. I talked about hope, fear, greed, and regret. If I could put all of those emotions in a basket and minimize them, I felt like I was doing a good thing. What I didn't want to do was become too overzealous about my trading and start to think that I was onto something because I knew sooner or later if my ego got in the way, I could end up doing something really, really stupid. Now, there are times when I have really big positions on, and they might be 50% of my account, but they don't typically start that way, and it certainly doesn't come from an emotion. We're going to talk about reading the crowd and understanding the crowd a little bit this week. But um, ebbing and flowing in your account, or if you have a position on and it's making you money, and on one particular day the thing is down 25 or 40 cents against you, that doesn't necessarily mean that you're losing money. It just means that when the market moves up and down, right, there's going to be an ebb and flow to uptrends and downtrends, and you're going to need to understand those emotionally. That, I don't know if you want to call it a pullback or just a decrement of 40 cents. To me, that's not necessarily losing money. So that's not necessarily anything to fear. It's not anything to have a regret about because you didn't act sooner to preserve that. I like to think in terms of $10 moves. If I can't anticipate something moving at least $10, then it's not and again, I don't use price targets, but if you look at the charts, you can kind of see as you look to the left if there's any structure that was there and how long ago that structure was. You'll want to see that structure being weeks or months ago. I don't care about intraday highs or weekly highs, new weekly highs. I want to see, if I look to the left on the chart, nothing but clear blue sky for the most part. And by doing so, I don't sit back and say, I hope this thing goes up, because I have a protective stop and I know that X amount of times my trades I'm going to get knocked out. And that's within model. We talked about overconfidence, but we want to also address the concept of what happens when you don't have any confidence. That's a tough spot to be in. So then you have to really make sure that all these other secondary feelings don't come in and really start to undermine you, because then it's like, what the hell are you doing all this for? So I don't want to have regrets. That can happen when you have a protective stop in. Let's say you're risking $1, and when the name is 80 cents off of your basis, you start adjusting your protective stop lower, in which case you get stopped out. Now you have regrets because you're like, man, I should have just kept it where it was and, taken the small loss as prescribed. The other type of regret shows up is when you automatically take trades off at 2R or 3R, right? And you realize, like, wow, after the thing goes up 5 or 6R, and look, it doesn't go straight up, it goes up and down, but it oftentimes it goes there and you're not participating. You have to figure out, why is that? Why don't you have the self-confidence to stay in the winning trades, right? So I never wanted to have regrets either. So I had to watch my behavior to make sure that those feelings didn't show up. Now, I showed a good way to do that. If you go back to the YouTube channel, you might be on the YouTube channel. Look under the live tab. You can see the replay of the live stream that we did, and we talked about progressive exposure. Greed, I talked about that a little bit yesterday. Tomorrow, of course, there's going to be some earnings announcements that the whole world will be looking at. So you just have to be careful and just make sure that you don't start looking into things and know that when fear and greed, to me, they don't really have any place in trading, right? Because again, if you have a constant bet size, you're just seeking abundance, right? You're looking to grow your money in a very deliberate manner. Greed is like something where you want something, to me anyway, more immediate. You want to love it, a lot of it, and you want it right now. I think there's a big difference in that regard then emotionally between greed and abundance. Greed is like it's insatiable, right? Too much is never enough. And you see that in people when they overdrink, they overeat, they're oversex, they overgamble, any of those kind of things. And I'm not judging people per se. Yes, I am. I just I think if you stay in balance over the long run, you're going to be fine. And in that process, by staying stuck to your discipline, that's going to be the biggest education for you. Because avoiding hope, fear, greed, and regret, you go a long way to just staying out of your own way. Because it's really your behavior that evokes those feelings. It's not the stock market or the commodities markets, right? Because those prices in the short run are oftentimes just very random. So why would you become emotionally invested in the outcome of, you know, something that you can't predict nor that you can control? The only thing that you can control is your own behavior. And that comes down to position sizing in many ways. The entries and exits don't have to be terribly precise. Where you make and lose your money is in your position sizing. So take that all into heart and just realize that this is a marathon, not a sprint. Everyone wants results overnight. They typically don't come that way. But if you put in the time, you're going to be okay. You know? Another question came in from Lion Trades on how to win at the game of trading. Could you talk about overnight risk? When trading with options, oftentimes I find myself losing or winning a lot just because it's impossible to manage risk during the pre-market or after hours with options. What would be your take on this? Thanks a lot. Well, again, we come down to position sizing. I don't know what, again, if you have an option that you bought at $4 and it trades down to 3, I don't know that that's necessarily losing money. That's a position that's worked against you a little bit, but you would need to know from your back testing if that's typical behavior for the instrument given the time frames with which you travel. Lion Trades, if you go back and look at the interview I did with Sean McLaughlin on the channel, I don't remember the title of it, but there were different ways to position size. And so I wouldn't, one, I would think longer time frames. I wouldn't think of zero DTE or options that are going to expire within a few days. I think you want to have more time on your side, even if you have to pay for it. And for all the options people out there, stop worrying about theta. Theta doesn't exist. If the name of the underlying instrument is going to move enough, which is why you'd be thinking about buying the calls anyway, for example, theta is an afterthought. You're worried about theta as if you're an investor or you're buying leaps, right? So to me, it's incongruent for you to even worry about theta. Theta starts to really click against you like at the 21st day and thereafter if you're going to hold these positions for days, right? But if most of you are day trading or scalping with options, theta is not an issue, right? So you don't have to, I've now just absolved the worry. You don't have to worry about theta anymore. Mike, can you discuss how you use alerts for trailing stop and not to sit in the screens all day when trading momentum breakouts with trailing stop? I find myself constantly checking to make sure that the price structure isn't breaking when it's trending, right? So, I mean, if you're looking at daily charts, they're not going to change all that much if you look every few hours. Don't try to look at it with intraday stuff, right? Position size yourself. This is Daniel Codolatonio, 9335 on what is your max loss limit. I think how do you use alerts is just like setting an alarm. If you know that you have to get out of bed at 5 in the morning, you set your alarm at 4:30 to kind of wake you up, right? So that you can kind of stretch, acclimate yourself, maybe have a second one go off at 4:45. I don't know. But I mean, the alerts that you set on the screen, to me, I don't know that I could add an edge to that other than you put in a price, if you look at what the volatility of the instrument is, you put the alert in before where you would have your buy stop in above the market so that the market trades into your price, right? So I don't know what that's going to be because it varies from instrument to instrument. But you would set it obviously so that the alert would go off first, and then you would say, okay, now I'm say 50 cents. It depends what the instrument is, right? If you're looking at cocoa and it has a vol of 750 ticks, that can happen anymore in a 3-minute window. So you have to, it depends on the instrument. So that's you know that's about the best I could do there. I learned more on this guy's channel. There's an apostrophe S. This time it's different. How to overcome your hesitation and stop missing trades. I learned more on this guy's channel than I did at Wharton Business School. Man, I don't know about that. Wharton's a great school. Um, I went to a different Ivy League school, but a lot of smart people there. Florida Money, how to overcome your hesitation and stop missing trades. This is the best of YouTube. What a great channel. I'm trying to get to the questions here. Yeah, corruption. Thinking about Soros and Druckenmiller. This is on a video called Copy This Top Trader Trait and Increase Your Returns. Looking over your shoulder would be terrifying. I don't know why that would be. They're pretty nice guys. I can just think when I'm about to push the button to get out of a trade early, they just start grinning at each other, thinking about a bonehead I am for closing out the trade when I'm clearly in profit. I know you've talked with Victor Sperani and like to know what Soros and Druckenmiller mindset are when they are in a winning trade. Do they think we're in a profit right now? Let's mash the gas harder and keep pushing. Definitely something we could learn from. So again, go back to progressive exposure. I haven't talked to Stanley or George about it. I talked to Jim Rogers about it, who was in Quantum. Victor was working at Quantum. Victor will be on the show a couple of days. And you kind of think what you want to really do is just, if you buy something at 10 and then you buy more of it at 16, I know some of you are like, dude, I'd be long gone by 16, but therein is the problem, right? That's to me, retail thinking. You want to start to think institutional so that you could start to build greater amounts of capital. And I know I get lots of snarky stuff, but, about, short-term trading, it's just that it depends on how quickly you want to grow your money, right? If you want to do blue-collar work to grow your account, you could definitely do it. But the majority of the people who fail are doing it on the short end. That's where the failure takes place. There's much more success in the intermediate to the longer-term holding periods. Now, I know that's hard because folks have smaller accounts and they're afraid to lose the money. And I know that there are a lot of prop trading firms in Chicago and in New York and London and Tokyo and Hong Kong, because I hear from them and I consult to a lot of those people, and they're like, some of our biggest traders are scalpers, and I'm like, yeah, but they didn't start that way, right? It's easy to scalp when you've got a credit line of 15 million. You know what I mean? Because a small rate of return is still a lot of take-home pay. But when you're trying to do it with 10K, you're working for peanuts. And again, go back to the replay of the live stream and think about how, you're going to grow your account from 5K to 50K. That's where my head was at. And, nowadays, again, you don't have to deal with the commissions, but you have to be practical. You can't believe everything, that people say because they're trying to sell you stuff. So these are a lot of the questions deal with, hope, fear, greed, and regret. But don't worry about losing money. Just know where the maximum loss is that you're willing to take from a financial and emotional standpoint on any one particular trade. The goal is to be able to do that and to not feel the strong feelings that would compel you to want to take action that would eventually hurt yourself, like to go on tilt or think about revenge trading, right? And if you're trying to trade on short-term data, that data is the most random data you can be looking at. So you're trying to make really important financial decisions on very, very random data, and then you fall to pieces when it doesn't work out. And some of us who are data scientists would look at you and say, well, what the hell did you expect was going to happen? It's like going outside in the morning and feeling a breeze and being like, oh man, hurricane's coming. Like, you can't draw those conclusions. And I know many of you have kind of learned or are learning the hard way that the stuff that goes into the marketing doesn't always look that way after you've paid for the product. You see what I'm saying? So take it easy on yourself, trade small, realize that this is a marathon, add to your winners. That's what Soros and Druckenmiller did. They bought at 10, they'd buy at 16. So now, yes, their average cost is 13. They have more of a position. If you work out the math, it's still the same. Now, you can do that using some measure of volatility. It doesn't have to be ATR. It could be whatever number you're comfortable with. There's no set rules. This is like being an artist. So much of this is you have to do it yourself. What feels good, what makes sense for you financially. You're only going to get that from iteration and trying. And that's the practice, right? Then or you can trail structure, right? You can look at structure and say, okay, where is there on the daily or the weekly chart, forget the intraday nonsense, where is there substantial support? Whereas if that support was broken, I would know for sure I'm on the wrong side of the trade, right? Which reminds me, don't worry about these guys selling the boogeyman type of a deal saying that your stops are going to get hunted. Market makers don't want to buy stocks that are going down, right? They have to have inventory, but they're not looking to acquire a big block of your stock or futures position if it breaks support and it's headed lower, because then what are they going to do with it, right? Then they have to go out and sell it to somebody else. So, think practically about this stuff. Anyway, tomorrow we're going to talk about leverage in your account. If you like this video, check out this one.